Americans' required minimum distributions may be higher this year in 2024 than ever in history. Hi, I'm Dave Lopez, founder and managing member at ILG Financial.
And I'm Chase Lopez, financial advisor at ILG Financial. And this is another episode of Retire Your Way with ILG Financial, where we talk all things retirement planning. And don't forget, hit the like and subscribe button below so you can be alerted for all of our future videos.
Yeah. So Chase, let's jump right into it.
Mm-hmm.
What is Fidelity talking about? Why do they think that required minimum distributions, the amount that has to come out of your 401k and your IRAs and be taxed,
right?
That amount, total amount, will be higher for Americans this year than ever in history?
Yeah, and before we jump right in, Dave, we do have another video on required minimum distributions. If you want a little more detailed information about those, you can just click the link below, and we have another video about that. But to your point, Fidelity did say, right, this year, 2024, is going to be the largest required minimum distribution withdrawal by the retiree group collectively in a very long time. And the reason for that is, without getting too much into the weeds, your required minimum distribution is based on your December 31st end of year account balance the previous year. Right. December 31st of 2023, right? So we've had in 2023, we had quite the run in the stock market. So a lot of retired folks, their account balances were about as high as they've been. So that means that their withdrawal that they have to take is going to be based on that higher account balance. Now, why? That means they're taking in the income, and it's going to show up on their tax return, right?
Yeah. So Fidelity is very confident in that number, and the reason is, to your point, to make sure we understand how RMDs are calculated. They're confident because we already know what the account balances were on December 31st. Right. So we know exactly how much your RMDs are, and your financial should already have the information for you of what this year's RMD requirements are. So that's for a national level, while the bucket of money is. Now, who's that good for?
Federal government, right?
Great for right, because they're getting tax dollars on all their money. Remember, they've been waiting patiently on your tax-deferred 401ks and IRAs, and now it's time to collect, and they're ready to collect that money. There's another reason, though, that the total national RMD tax take, I would say, tax haul is going to be bigger than ever. Not only are the accounts high because we had a good year, but remember, we have never had more people taking RMDs in history, because the biggest generation we've got is the baby boom generation, and they are squarely in this retirement RMD bubble. Right now, about 10,000 people a day, if you can believe it, in the United States are turning 65. Right? Depending on who you talk to, the baby boom bubble is from the back end is 1963, and the front end 59, 49, 49. Yeah. But you get the idea. The point is that the majority of that group is already at 70 or 71 or 72. This year, just to give you an idea, this year more people are turning 65 in the U.S. than any other year in history. So it shows you this huge. When you talk about the baby boom generation, think of this visual. It's not pleasant, but think of this visual of a bowling ball moving through a python, right? Anything this mass of humanity touches, it affects, right? Whether it's if they're a certain age and they're buying something. When they were babies, Gerber baby food went through the roof. When they turned between 18 and 20, there's just a sheer number of them wanting sports cars. And Lee Iacocca introduced the Ford Mustang, and it took off. It took off because you had 65 million Americans in this demographic, right? Well, now that whole group is moving into retirement and moving into RMD age. So you're going to see this trend continue, which for the government's a good trend, of massive amounts of money having to be required to be pulled out and be taxed.
Yeah, and I think Fidelity said it's going to be somewhere around $25 billion has to be withdrawn from folks' retirement accounts. They have to pay taxes on that money, right? And what a lot of people just haven't thought about, right, unless you're working with a financial professional, hasn't really occurred to them that, let's say you have a couple Social Security checks, maybe a pension or two. Well, that IRA or 401k distribution that you're taking, that's going to be stacked on top of that income, right? So that's going to be the highest tax bracket that you pay is going to be on these withdrawals that you take, which can create some tax issues when you get into retirement.
Yeah,
right?
or worse, you may be paying more taxes than you were planning on your IRA withdrawal. Right. So there's some fixes. So this video is for you. If you said, well, what do I do? There's some things you can do. So we're going to go over with 2 or 3.
Yeah, just about 3. Yep.
Right. So the takeaway is get with your financial professional and say, hey, this is an issue, a concern for me. What are we doing to address this? What can I do about it?
Yeah,
right. And if they don't have an answer, look for another financial professional.
Right. So the first one is what they call a qualified charitable distribution. I'm sorry, I had to look at my notes there to make sure I got it right. It's QCD, qualified charitable distribution. And all that is that you can basically say, hey, I have to take this money out of my IRA.
That's right.
Instead of you taking it and putting it in your bank account, you have it sent directly to the charity of your choice. So whatever charity you like, you can have it sent right there. That way it doesn't show up on your tax return.
Yeah, and that's a biggie because right now a lot of people's concern, and this may be you listening, is that, hey, I used to be able to donate to my charity, church, SPCA, you name it, right?
Yeah.
I used to be able to donate to my charity and deduct it on my taxes. But with the Trump tax changes and the larger standard deduction, a lot of people are like, look, I can't deduct my charity because it doesn't take me above the standard deduction. Well, this is a way around that, right? You can still get your standard deduction. And when you do a qualified charitable deduction to your charity, let's say it's $5,000, that $5,000, you don't get to deduct it, but you also don't have to count it as income as a withdrawal from your required minimum distribution.
Right.
So in effect, you're deducting the $5,000. Now, let me just point out, Chase, this is important. A lot of people say, well, I lost the whole $5,000. I'd rather pay taxes and end up with $5,000 minus 20% tax.
Sure.
So that's only a solution if you are giving the $5,000 away to charity anyway.
That's a good point. Right? That if you were going to be contributing or donating to charity, it's a very tax efficient way to do it. Would you say that?
But it's important because so many people we meet with are giving, in this example, $5,000 to charity. So they take their required minimum distribution, pay tax on the $5,000, put it in their checking account, then give it to charity and can't deduct it. Right. Whereas if the $5,000 had just gone to the charity, they would have been able to deduct it. Say basically, if it was a 20% tax bracket, on $5,000, that's $1,000. They would have either been able to donate extra $5,000 or keep $5,000 in their pocket and donate the same amount to charity.
That's right.
Qualified charitable deduction is one way to help this situation with taxes on RMDs. What's number 2?
So number 2 is there is a exemption for required minimum distributions. Now, you have to qualify a few different ways, right? The first is that you have to still be working at your required minimum distribution age. So for some folks, it's 72. For some folks, it's 73. But in any event, you have to be working during this time. And if you're working and your employer that you're currently working for has a 401k, then that specific 401k, you don't have to take required minimum distributions from that account.
While you're working.
Now,
there's a lot of exceptions to that. And the first one, and I'm glad you mentioned it, only the 401k from the company you're currently employed with.
That's right.
So if you've got $100,000 in the 401k you're currently working with, and you've got 50 in an old 401k, that $51,000 in the old 401k is not exempt.
Correct.
So what do we do about that? There's some tricks. One, check with your current 401k company. They may let you roll your old 401k into your new one.
Right.
And that would give you some time, right? Some will let you maybe even roll an IRA into them. Not all, but some may be. Now, I will tell you this. I don't know that that's a good solution. And the reason is you've only deferred the tax.
You've delayed the inevitable, right?
You couldn't have said it better. We've delayed it. And if you think over time, and this is a bet you've got to make, and we've got another video on this, but if taxes are going up in the future, you might be better off paying the tax now at the lower rate. Right. But that's a different conversation for a different video.
Sure. And like a lot of things we talk about on our channel here, make sure we're speaking very generically, right?
Yeah.
Make sure you get with your financial professional to see which strategy works best for you. But that is one way to delay the RMDs more so than anything else, right?
Yeah, it's really probably the bigger way to do it would be, if we're not worried about, you don't delay it and think we've avoided tax.
Right.
It really is, this enables you to really look at your current tax situation, the possible future tax situation, and start to do some planning, as take some now and some later, or none now and all later. But you can actually map it out and see what's the best, assuming taxes are going up. Or if you think they're going to stay the same, you can take a look at it and assume they're going to stay the same.
That's
one more,
That's right?
So that was qualified charitable distributions can help. If you're still working, and only for those still working, and you have a 401k, we can delay. Again, you can't delay your IRAs, right? But the 401k of your current employer you can delay. And then the third one is, this is really something you'd have to do before required minimum distributions.
That's right.
You can take some opportunity to start to move stuff out of your IRAs and 401ks and into Roths. And by doing that, the disadvantage is you have to pay the taxes on them then. But when it goes into a Roth, it's tax-free now for the rest of your life. All growth after that point is tax-free.
That's a great point, Dave. If you are doing some forward planning here, and you have a bunch of money in your 401k or your IRA in those tax-deferred accounts, and you have a bunch of money in there, and you have some time before you hit that required minimum distribution age, then absolutely you should be getting with your financial professional to make sure that if you think taxes are going up, and quite frankly, even if you think they'll stay the same, you need to be having the conversation of, hey, we want to make sure that this tax deferred bucket doesn't get too big, because we're going to have to take money out down the line, right? It's a requirement by the government. Yeah,
a lot of folks, you'll hear tax people and advisors, they'll say, well, that only is a benefit if taxes are higher later. That's true, actually, mathematically true. It's also mathematically true that if taxes are exactly the same for you, it wouldn't have mattered which way you did it. So you lose nothing by doing it.
That's right.
And it's only a disadvantage if taxes are lower.
That's right.
So you are going to have to make a bet,
right?
And talk to your accountant and your financial professional and read all you can about national debt and what's going on, because you're going to have to make a bet. Now, you probably get an idea from this video what we believe and what we tell our clients, but it's based on data and information. And if you want more, reach out to us. Okay. But here's what a lot of people don't mention, and why we love the idea of these Roth conversions. When your RMDs start, which we've been talking about, right? And now let's say $10,000 comes out and you have to pay tax on it, 20%. Now you're down to $8,000. Okay. Now that $8,000 cannot go into a Roth. You cannot do a Roth conversion. So that means it has to go into your regular account, and a regular account is taxed as you go. So if it's a regular account and next year you get $1,000 interest on that $8,000, that year you pay tax on that $1,000. And every year for the rest of your life that you're earning interest or dividends, you're paying tax on that money. If it had gone into a Roth, you could be making the same $1,000 and never be paying tax ever again on any of it. So the Roth conversion, even if taxes are the same later, if it enabled you to move the money into a Roth instead of into a regular account, you're going to have a huge benefit if you can hold that money and grow that money over another 10 or 20 years. And if you don't need it and the kids inherit it, they inherit a Roth, they pay no taxes. Right? Depending on the taxes you go account, they may or may not have some tax consequences. It's different, but we know they're not going to have them in the Roth. But just being able to accumulate wealth, accumulate interest and growth and capital gains and never have to pay tax on it, to me, that alone is worth rolling it to a Roth.
Yeah, that's a good point. Really, the big picture, right? You could say, hey, if you move the money into the Roth, I'll pay tax today and never pay tax on this money ever again.
You got it.
Right? So that was three ways to help avoid this big RMD problem that folks can have. Again, get with your financial professional to see how some of this stuff applies to you specifically, and we'll talk to you next time.
Talk to you next time.